following is a Silver Bullion television audiocast. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Today we have with us Mr. Dave Kranzler, the founder of Investment Research Dynamics. Dave has nearly 30 years of experience in studying, researching, analyzing, and investing in the financial markets. He co-manages a precious metals and mining stock investment fund in Denver, Colorado. He publishes the mining stock and short seller journals on his website, investmentresearchdynamics.com. We're delighted to have him here today as our guest. Good day, Dave, and welcome to SBTV.
Thanks for having me on, Patrick. I'm looking forward to our conversation.
Yeah, so am I, and I'm sure the viewers, they'll be quite thrilled in the end. First topic, gold. Had a pretty good beat down a couple of days ago, unfortunately, or fortunately, depending on how you look at it. But 2011, we haven't quite seen those numbers. It's been down, it's been sideways, and it's been that way for quite a while. We have some people who own gold. Their resolve is getting tested. What would you say to this as far as the market being sideways for quite a while? And is it a good asset to buy right now?
I'm probably the wrong person to ask about that because I'd be accused of being biased. I mean, it's, what's your alternative? Do you feel, you can spend dollars, and the Fed's been certainly printing a lot of them, or had been printing a lot of them.
Right.
But in terms of, holding an asset, gold has a 5,000-year history of holding its value. Fiat currencies, in fact, the current period of the fiat dollar as the reserve currency is one of the longest periods in the history of civilization where, right. The fiat currency has lasted this long, and it looks like, I think the dollar would have died out in 2008 if the Fed and in collusion with the other Western central banks didn't step in to kick the can down the road. So, I'll say this, you need to have a long-term perspective for gold because economic and currency shifts happen over a long period of time. So in fact, I just kind of reviewed that in my latest short sellers journal, where, the U.S. didn't start emerging as the world's dominant power until after World War II. Right. And now it looks like the U.S. is going to start playing at least second fiddle to China, if not some of the other countries that are rising up. So I'll also say this, depending on how you measure your time period in gold, gold's been one of the best performing assets over the last 2 decades. If you bought gold in late 2000, early 2001, and you just held it, you're sitting on an investment that has outperformed any major investment. There might be I think there's some oddball commodities that have performed better in that time period, but certainly against any measure of the stock market, maybe not certain individual stocks. But if you just bought a Dow Jones ETF or an S&P ETF, and you also bought gold in, just call it January 1st, 2001, you're way better off having owned the gold. So, I think we had a big run up in the price of gold percentage-wise starting in the middle of December 2015, and a lot of hot money piled into it. Right. And it kind of exaggerated the move up that it made. And so I would probably argue that the current period that we're in right now in terms of the price of gold is sort of a consolidation pullback period. I mean, it's digesting the move that we had in gold from, essentially mid-December 2015 until, let's just call it that the price sort of peaked out in July of 2016. So you had a very sharp move in gold in about a 7-month period. So, and then you had a big sell-off. And if you look at a 2-year chart of gold, it looks like it's in a really nice bullish uptrend pattern, and the current sell-off is coming back down to kind of that uptrend line. So whether or not it'll break below that, if it does break below it, I think it'll break below it only temporarily. I mean, I think a lot of market participants with respect to who are involved in gold and silver understand the fact that it's highly manipulated. Right. And it's highly manipulated using paper gold derivatives like COMEX futures, LBMA forwards out of London, and then there's all kinds of OTC derivatives that a lot of people aren't even aware of. But the banks have very large positions and underwrite a large amount of precious metals OTC derivatives, and they're all used to manipulate the price of gold. Now, can the central banks successfully manipulate the price of gold? Sure, over short periods of time, but again, gold started out at around 250 in 2001 or thereabouts, and now it's gone as high as 1900, and we're sitting at about 1290 right now. So right. Over that time period, the Fed has not been successful in manipulating the price of gold. I would say they've been manipulated in slowing down the rise in the price of gold. And in that same time period, you've had enormous buying from various Eastern Hemisphere countries and central banks. I mean, obviously everyone knows about India and China and Russia, but there's a lot of other smaller countries that, as a percentage of their currency reserves, have been buying enormous amounts of gold. Turkey's a good example of that. So Turkey imported about 360 tons of gold last year, and they're on pace to do that same amount this year, which is probably surprising people because all you hear about is the crashing Turkish currency. So, right. But that amount of gold that gets imported doesn't account for the gold that's produced internally. Turkey also, a lot of gold is mined out of Turkey. So I guess that's sort of a long-winded way of saying, yeah, I think gold is a great investment right now. I think it's a great wealth preservation asset right now. And is it going to go lower from here? Possibly in the short term. I mean, you never know how low the manipulators can get it. But I think now's a great time just to kind of close your eyes, hold your nose, and buy gold. Or if you already own it, add to your position.
Yeah, I hear you. I think the last time I seen gold doing well was the night Trump got elected. It did very good, and then all of a sudden it just kind of fell off the cliff. But,
perfect example of the manipulation, the intervention in the gold market.
Yeah, but getting back to the year 2015, the gold prices bottomed. Do you think
yes.
we're going to see that time again, or have we passed it by?
I hate to make concrete projections, absolute projections about where the price of gold is going to go, because again, I don't know how desperate or how extreme the central bank intervention is going to get. For me personally, I am of the belief that gold actually bottomed out at 1,060. Forgot it went that low. Okay, so it was at 1,060 and it's been as high as 1,360. So you're looking at almost a 30% rate of return since mid-December 2015. I mean, I know people think that they're entitled to buying a stock like Amazon and watching it double in a year, but 30% in 2 years in a safe asset like gold is a really good rate of return. Is it going to go back to 1,060? I personally don't think it can, and the reason for that is just the enormous amount of physical gold that's being purchased and has to be delivered. And you've probably seen the articles about peak gold production. Yes. That's real. That is real. There's not been a major, huge mine discovery in like the last 15 years. I mean, when I first started in this sector, which was in 2001, a 5 million ounce discovery or a 10 million ounce discovery was considered a good discovery, a large discovery. Now most of the discoveries that are being made are well under 5 million ounces, and it's not enough to replace what's being mined out and purchased by just the Eastern Hemisphere alone. Now, if you start getting, Western Hemisphere entities and wealthy people starting to buy gold, which you will eventually, we saw it in 1980, and you will eventually get that. It's going to cause problems for the entities that are short paper gold derivatives. It's probably going to cause a short squeeze, and I don't know when that's going to happen. I mean, we saw that happen in 2011 when gold ran pretty quickly up to 1900. So I just think that there's a significant amount of physical market purchasing that provides support underneath the price of gold. I mean, for instance, Goldman Sachs, for the longest time, 4 or 5 years ago, was calling for gold to go to 800, and it never did. They never got it below 1,000. They tried, and it never happened. So
I think Harry Dent was in the same boat with them.
Yeah. Well, I'll tell you what. When back in late 2003, Robert Prechter of Elliott Wave fame came out and said, and this is when gold was banging its head on 400 and getting ready to punch through 400. Prechter issued a very public prediction that gold was going to go down to $50 an ounce. I mean, not only did it not go down, it never even went back to 300. I mean, shortly after that, it broke through 400. So I would, I dismiss anything Harry Dent says. So.
Okay. So I guess
is gold going to get down to 1,200 in this cycle? I don't even know if they can get it down to 1,200 at this point. And it's at 1,290 now, or 1,289, whatever you want to call it. I'm not sure it's going to stay this low for much longer. I mean, I think we're going to get, we'll probably have one shock and awe sell-off ahead of us. That'll be a manipulated sell-off, but it's going to rebound very quickly. I mean, gold went through 1,300 a couple nights ago, and literally the next day, because I subscribe to a publication, we use it for our fun. It's very expensive. John Brimlow's Gold Jottings, and he publishes the Indian import and Chinese Shanghai Gold Exchange data every night. And as soon as gold went through 1,300, all of a sudden Indian buying ticked up and Chinese buying ticked up. So those buyers over there, who again, they require gold to be physically delivered,
right?
They love it when the Western central banks manipulate the price of gold lower, because they have a lot of dollars that they want to move into gold.
Right. Yeah, I mean, I guess part of the reason why I asked that question was because for guys who just got into, let's say, gold and silver, it's somewhat okay to tell them, don't worry about the price going down. It just means buy more. You can average down. But for guys who have been in it since 2010, 11, 12, it's not exactly what they want to hear. But,
well, again, it depends. I mean, a lot of people who came into the market in 2010, 2011, I think came in for the wrong reasons. I think they were chasing momentum higher. Now, some of them may have just become enlightened and aware of what's going on in the country, financially and economically, and wanted to own gold. But again, you got to look at gold as a long-term investment.
Right.
Again, I can't reiterate enough. If you measure it from 2001 to now, it's been one of the best performing assets. And I would suffice it to say that between now and the next 5 or 10 years, it's probably also going to be one of the best performing assets. And let me just add to that. It's been one of the best performing assets over that time period, despite the fact that it sold off from 1,900 back down to where it is now, just under 1,300. So you've had a 30% decline in the price of gold, and yet over an 18-year time period or 17-year time period, it's been the best performing major asset.
Yeah, still definitely fights off inflation, so there's not much you can complain about, I guess.
Yes.
You research and publish the Mining Stock Journal on your website, investmentresearchdynamics.com. What's your view with holding physical gold bullion like bars and coins versus holding gold mining stocks, and how should investors choose between these two types of gold assets?
I think you need to own both. Okay. And I also think it depends on how bearish you are. I mean, I have colleagues and friends who are super bears, and they think we're going back to the Stone Age, and that's a possibility. But and so they only own physical gold and silver bullion, and because they're worried about the safety of the entire financial system, as am I.
Right.
And there's
Same
certainly, if you own mining stocks, there's certainly going to be custodial risk in there. But I do think that the way I like to look at it is, I have my core holding in gold and silver, and that's probably the majority of my asset base right now.
Would that be physical
probably,
or?
Well, it is. Gold and silver that I hold in my possession,
Mhm.
and then you want to have some mining stocks for the optimistic case that the system implodes, but we don't go back to the Mad Max Stone Age scenario. In which case, the mining stocks are a great way to enhance your wealth, because for mining companies that have bona fide gold in the ground that can be successfully mined, and not all of them do, and also for companies that have gold in the ground and are actually producing it, with where the fixed cost is of producing gold, every dollar the price of gold goes higher, because right now the price of gold is well above the fixed cost of producing gold, and actually really the total all-in cost of producing gold, for that matter. So for every dollar the price of gold moves higher, you get an amplified effect. You get the leverage of that by owning the miners.
Right.
And if gold, well, I won't say if, when gold goes up to 2,000, these mining stocks are going to be worth 5 to 10 times what they're worth right now.
Right.
Because all of that increase in the price of gold is going to fall to the bottom line and turn out, generate just enormous amounts of cash flow.
The mining stocks, would you say they're in undervalued territory right now?
Extremely undervalued. In fact, I had in my mining stock journal that I sent out last night, and there's a chart in there. Let's pull it up here, and it shows the price of gold relative, and this would be for the mining stocks as well, it would apply. It shows the price of gold as a ratio of the U.S. monetary base, and it goes all the way back to 1920.
Oh, wow.
And you can see the two periods in time where it really spikes up and would be considered overvalued relative to the monetary base. And one of those time periods was 1980. Believe it or not, there's been so much money printed since 1980 that the spike up that we had to 1900 barely registers on this chart. And it's, over that time period, you can see where gold is extremely overvalued and where gold is extremely undervalued. And it's the most undervalued relative to the U.S. monetary base that it's been since 1920, at any time since 1920. And so the same thing would apply to the mining stocks. In fact, if you look at a ratio of just call it the GDX as a ratio to gold, the price of gold. The GDX gold ratio was the lowest it's been in the last at least 20 years in December of 2015. Mm-hmm. And it moved above that extreme undervalued level, but it's still, relative to where it's been any time in the last 20 years, the mining stocks are undervalued relative to the price of gold, or as undervalued relative to the price of gold as they've been at any time in the last 20 years.
How do you think gold's going to do the rest of the year, 2018?
It's a great question. I think what's happening right now, and I write about it on my blog, and I specifically write about it in my mining stock journal. There's a cycle that the COMEX goes through where the banks go from extremely short paper gold to less short paper gold, and as they're getting extremely short paper gold, the price of gold rises, and then they decide to pull the rug out. And on the other side of that, on the other side of the banks, are the hedge funds who get extremely long paper gold. Well, the hedge funds have been extremely long paper gold, especially since the run-up that we had starting in the end of 2015. and the banks have been extremely short. Well, I think what this current price hit is accomplishing right now is it's allowing the banks to cover their shorts profitably. The hedge funds will puke out their long positions, and we'll start the cycle over again. And so, again, it's impossible to know how low gold can go from here while they're finished flushing out the COMEX long-short structure. But I do think it should be. I think we should be through this cycle by mid to late June, and then you've got the seasonal Indian buying period, their largest seasonal period of the year, where they buy gold ahead of
Right.
several festivals and holidays and weddings that occur throughout the fall through Christmas in India, and that's usually a very strong seasonal period for the price of gold. So. If gold can get through that 1360 level, between now and September, I think we have a good shot at seeing 1400 by the end of the year, if not higher. And
Yep.
again, I'm not saying that's my hard number prediction because it's again, with the amount of manipulation that's going on right now, it's impossible to successfully forecast over short periods of time where the price of gold is going. If you said, where is it going over the next 2 or 3 years, I'd say it's going to be significantly higher over the next 2 or 3 years.
Yeah, I'd agree with that. Last year, gold had a pretty good year. It ended about 13% higher. I think silver also went up about 7%. So for our silver fans out there, you think right now silver is undervalued, and what's your views on silver?
Silver is kind of the tail that wags the dog in a sense. It's got a large beta relative to gold. It's more volatile. It's easier to manipulate.
Right.
So the downside is exaggerated in relationship to gold, and the upside gets exaggerated in relationship to gold. I mean, obviously, in the run-up period from 2008 to 2011, silver way outperformed gold.
Right.
Well, as again, I think once gold gets through 1400 and starts to move higher from there, I think you're going to see silver turn on its turbocharger. I love silver. I think silver is one of the most undervalued assets in the world, and I own a lot more silver than I own gold. And every time they smack gold, if I've got some cash laying around, I buy more silver.
Yeah, same here. It's not all that bad whenever the price goes down, but
And I want to say this also: it's much harder to find silver mine. As hard as it is to find good gold mining stocks and good junior gold exploration companies, it's even harder to find silver mining stocks and pure junior silver exploration companies. And the ones that are out there that I think are worthwhile owning, I cover them in my my mining stock journal.
Okay, yeah, it seems like primary silver miners, they're becoming an endangered species of sorts. But with all this manipulation going on, do you think that we're moving toward a cashless society?
I think that the powers that be would love to make that happen. I think for now there's enough pushback from the populace that you won't see it happen, but it certainly seems like they're trying to put in the ingredients to transition to a cashless society.
Yeah, I'm personally, for myself, I'm not in favor of a cashless society. I think that there's a lot more downside than upside, meaning there could be a lot more
The idea
control.
terrifies me, Patrick.
Same here. But there's a lot of people who do like it, and it seems to be the younger crowd that likes the cashless, and us seasoned people who don't like the cashless. Turning to the stock market, you've mentioned in past interviews that the U.S. stock markets, they are overvalued, while commodities, they've taken a hit in the last few years, and the stock market somehow kept marching higher and higher, hitting new records. Could you give our listeners an idea of the extent of this overvaluation, and how dangerous is it?
Sure. I just wanted to circle back really quickly to the end of the previous conversation about the cashless society, because something you had said triggered the thought, and that is, you're right. Some people don't seem to mind the idea of a cashless society, but I would tell you that most likely those people who don't mind the idea of a cashless society also do not mind that the NSA listens into their conversations and invades their privacy. In terms of the stock market, again, the degree to which it's overvalued has been covered up by changes to the GAAP accounting system, generally accepted accounting principles.
Right.
The GAAP regulations have been liberalized so that it makes it easier for corporations to report GAAP financial statement income. When I refer to financial statement income, I would just also refer to the fact that it's GAAP accounting based. So there's a lot of non-cash items that are either excluded or included in income. There's charges that these companies incur that they can put on the balance sheet and amortize over a long period of time, and that reduces the impact to the expense side. So, and I guess the best way to describe it is that if you took the GAAP accounting standards that were being applied in 1999 and applied those exact same standards to the current earnings of the companies in the S&P 500, I would, and again, I don't know anyone who has the time to actually go back and do this, but I would bet that the current annualized earnings on the S&P 500 would be at least 30 to 40% lower now if 1999 GAAP standards were applied to their earnings today. Does that make sense?
Oh, it does make sense, because when I look back at that time, I see Bill Clinton and his Glass-Steagall Act, and I think that was the Pandora's box that was opened up, starting from there.
Yes, and the financials are a big portion of the GAAP changes. They account for a big portion of the changes in GAAP that have allowed them to recognize a lot of non-cash events that they convert into financial statement, cash flow, and income, and not cash flow, but income, and that's all analysts look at anymore. They look at earnings per share, and PE ratio. So the point here is that if in 1999-2000 period, if the PE ratio on the S&P 500 peaked out in the low 30s, okay, a 30 PE ratio back then is a lot different than a 30 PE ratio right now. So if you applied the 1999 GAAP accounting standards to today's earnings stream on the S&P 500, the PE ratio would be, well in excess of 40 times, which again, and if you strip out the tech stocks, because their valuations were insane at the end of '99, most of them didn't even have revenues or earnings, so it skewed the PE ratio higher. So if you strip out the tech stocks and you just look at basic industrial and consumer stock PE ratios, the PE ratios now are by far the highest that we've ever had in the history of the U.S. stock market, and that's how overvalued. And one way that you can do a check and balance on this assertion that I'm making is just look at revenue growth. I mean, revenue growth for the S&P 500 companies has been, minute, if not flat. And for a lot of them, I've seen some studies where it's taken a handful of companies and their revenues have actually declined over the last 5 years. And these are S&P 500 companies, and yet their stock valuations keep going higher. So if you were to look at, say, a price to revenue ratio, and I haven't done this for about 6 or 9 months, I would say that right now we're at the highest price revenue ratio, price to sales ratio of all time. And if you look at median operating income, price to median operating income, we're also by far at the highest price to median operating income ratio of all time. So that just gives you, some degree of how overvalued the stock market is. Now, the Fed printed obviously many trillions of dollars, and that a lot of that money went into the stock market. Well, the Fed's not printing anymore. So what's going to be the source of the cash that's going to drive the stock market higher? Again, I would argue that the fact that the stock market has kind of hit its head on a ceiling and seems to be trending lower is part of that is a function of the fact that the Fed's not printing any more money right now.
You think major corrections on the way, Dave, that could rival the 2007 financial crisis?
I think we had a major correction on the way that started at the end of January, and I think the Fed stepped in and prevented it from getting worse. And I think at some point they're not going to have the ability to step in and prevent it from getting worse. I have a good friend of mine who did a study on pension funds, and he works in the industry, so he has access to pension data that most of us don't have access to. And he concluded, after looking at all the public pension funds and running stress tests, that if the S&P and the Dow were to drop 10% or more over an extended period, where an extended period is defined as 3 to 6 months, that every single pension fund in the country would blow up. Public pension fund anyway. That's the data he looked at. And you'll notice when we've had 10% drawdowns in the stock market, they're followed by a V recovery, and that has to be the Fed stepping in, because they know the data as well, probably better than my friend knows it. So there's partly a policy issue here that's kind of forcing the Fed and the Treasury to combine. They're known as the plunge protection team, to preventing a bigger sell-off than we've seen so far this year in the stock market. But I think at some point they're going to lose control, and I think that may be starting to happen now.
Okay, so safe to say that phrase we hear every now and then called the everything bubble, it's a true thing then? Yes,
absolutely. As that bubble begins to, we've already seen the effect of it beginning to deflate, because that's when gold bottomed, and gold ran from, just call it 1060 to 1360. Mm-hmm. So that and that's with these bubbles leaking, and a lot of that cash has been going into gold. Well, imagine what's going to happen when the bubbles blow apart. I mean, not all that cash is going to find its way into gold. There's going to be a lot of losses that investment funds and individuals incur, but cash that's successfully extracted from that market, gold and silver are going to see more than their fair share of it. And that's the rush that I'm really looking forward to.
Yeah, I mean, what do you think the relationship of physical gold and silver will be compared to paper gold and silver?
Well, I know in 2010 the ratio was about 100 to 1 in terms of there was 100 ounces of paper gold for every ounce of gold.
Right.
What that ratio is now, that's a really good question. I haven't seen numbers on it. In fact, the finance minister for India, that number was thrown out at a hearing in London back in 2010, and the finance minister or vice finance minister of India kind of confirmed that was the case, that was the correct number. He said the ratio was something like 93 to 1 at the time. I would say the ratio of paper gold to underlying physical gold has probably doubled from there, because I think that's the amount of paper they've had to issue in order to keep a lid on the price of gold.
And how do you think it's going to affect the mining sector in this type of a scenario?
I think the mining stocks are going to be one of the few stocks that perform really well. We saw that in 2008 when the wheels came off the financial system and the stock market was heading, the S&P was heading down to where it bottomed at 666, ironically. The precious metals, gold and silver, started moving higher at the end of October. Mm-hmm. And then in early November, the Huey index of mining stocks started moving higher. The Huey, while the S&P was going down at a 45-degree angle, the Huey was doubled. It literally doubled from early November 2008 to the end of December 2008. Literally, the Huey doubled, and so that's an example of what's going to happen with the mining stocks when the stock market really starts to head down for real.
Moving into U.S. real estate and subprime mortgage, the subprime mortgage market. It was definitely the catalyst that triggered the financial crisis of 2007, 2008. Mortgage debt declined after the crisis, but it has risen again to levels that were last seen in the 2007 crisis. Do you think the housing bubble is starting to rear its head again?
Well, I think the housing bubble was rearing its head, starting 3 or 4 years ago. And in the mid 2000s bubble, it was a bubble in both housing prices and the volume of housing transactions. This time around, it's been primarily a price bubble. And again, the rise in the price of housing is a manifestation of all the money that the Fed printed, because about a quarter of the money that the Fed printed went into mortgage-backed securities. And that completely, that propped up the housing market, and it fueled housing price inflation. The second huge factor in the housing price bubble has been, even though the narrative and the propaganda is that it's harder to get a mortgage now, that's actually not true, because the federal government, of all sources, now has been offering a 3% down payment mortgage since early 2015. And you don't even have to have cash out of your pocket, as if you're the primary buyer of the house and you're going to live in it. You don't have to have cash out of your pocket as your down payment. You can borrow it from friends and family. Seller concessions can be counted as part of that 3% down payment. I mean, and the FHA has been offering 3.5% down payment mortgages since late 2008. Right. So essentially, although you don't see the crazy, non-cash pay, exploding interest rate mortgages that we saw in the mid-2000s, essentially the government has stepped in and replaced a lot of the subprime mortgage issuance that occurred in the mid-2000s. It's just now, because the government backs it, it's not considered to be subprime. And they also lowered the standards on FICO scores. So, just like with, a PE ratio now is not the same as a PE ratio was in 1999. A FICO score of 700 now is not the same as a FICO score of 700 in 2005.
Right.
So essentially, even though it's not called subprime, the government has become, the major issuer of subprime-like mortgages. I mean, you've got your first-time home buyer can buy a house with 0 to 3% down, a 50% debt-to-income ratio. Now, 50% debt-to-income ratio means that 50% of the household's pre-tax income can be used for debt service, and you can still qualify for a government-backed mortgage. Now, I don't care what your FICO score is. I don't care if you have an 800 FICO score. Yeah. If you're using half of your income, your pre-tax income, to service debt payments, and that's not just the mortgage. That's credit cards, auto debt, personal loans, student debt. If half of your income is being used for that, that's a subprime piece of paper right there. When a dog vomits, he turns around and a lot of dogs will eat it, right?
Yes.
Well, we had a financial system vomit in 2008, and it was fueled by massive issuance of credit, of debt.
Right.
And apparently we didn't learn again, because the vomit is starting to come out again, and no one's doing anything to stop it. The source of the vomit was never treated. It was covered up, and so now, instead of, like last time around, it was in plain sight. Everyone knew what was going on.
Right.
Now people are like, oh well, it's government backed. It can't be subprime. Well, it is subprime. It's the same kind of dog vomit. It's just in a different package.
Okay, so they cleaned up the Dave, it's a funny one. So they cleaned up that dog vomit, but we're starting to smell it anyway with the adjustment of FICO scores, I guess.
They didn't even really clean it up. They monetized it. The Fed printed money, and that's what made it, quote unquote, go away.
Yeah.
It treated the symptoms of the problems, but it didn't fix the problems. And they, supposedly Dodd-Frank and all these other financial regulations, quote unquote regulations, that were put into place in 2010 were supposed to prevent that from happening. But here we are again, and it's the government itself that is fueling the problem.
Right. Trump administration, do you think they're doing anything to address this issue, or is their focus somewhere else?
No, Trump loves debt. Trump finally lost his casino empire after going through bankruptcy 3 times. Trump's never seen a debt offer that he can't refuse. I mean, look at just the first quarter of 2018 in this country. The government issued almost $500 billion in new treasuries.
Right.
The last time the government issued that amount of treasuries was in late 2008, because it had to spend a ton of money to keep the system from collapsing.
Okay, and prior to the 2007 crisis, mortgage delinquencies fell between 2002 and 2006, according to the Fed charts on their website. The Fed hiked rates from 1% in approximately mid-2005 to 5% in mid-2006. Mortgage delinquency rate then started to rise exponentially from Q2 in 2006, reaching into the crisis high of 2009. I want to point out that the mortgage delinquency rates are down annually since the high in 2009 at this moment. But with the Fed hiking rates again in the last few years, do you see any type of parallel with the Fed rate hikes and the bursting of the housing bubble?
Sure. And I'll qualify this by saying whether or not the Fed decided to hike rates, we were going to see the bursting of the housing bubble eventually anyway. The rate hikes are just going to speed up the timeline.
Right.
But first, again, I want to differentiate between delinquency rates now and delinquency rates back then.
Okay.
The banks have what's called excess reserves, just under $2 trillion now, and it enables the banks to look the other way on late debt payments. So again, what was reported as a delinquency rate, or when a loan was reported as being delinquent, probably a lot sooner back in the mid-2000s than it's being reported now. And the reason is the banks can afford to sit on bad debt and not acknowledge it, because they've got this big, huge $2 trillion slush fund called excess reserves. I will note, and again, I can't prove this, but the excess reserve slush fund account has gone down 13% since September. And the reason for that is the excess cash reserve is the cash that banks are holding on to that they don't need to use as reserves against assets being debt, being loans that they make. So the fact that the excess reserve account has gone down 13% in a space of about 6 months tells me that the banks have had to move a lot of that cash, 13% of that cash, into their reserve account category.
Oh.
And the reason why they would have, and loan growth, other than credit cards and auto debt, hasn't really been growing. So the reason, especially commercial and industrial loans, those have been kind of declining. The reason that they would have to move that cash out as reserves is because the value of the assets is deteriorating and they have to put up more cash against it. That's my theory right now. I don't have time to go and prove it, but I think that would probably explain at least 80% of the movement of the cash out of the excess reserve account. So, again, banks. Well, first of all, we're already seeing, delinquency rates are starting to spike up very quickly at companies like Capital One,
okay,
who, credit card debt and auto debt, and lots of subprime debt, in those, as subcategories of the debt. And we're seeing that they're every quarter now they're reporting higher delinquency and charge-off rates. So, whereas last time around, everything started from the mortgage market, I think this time around we're going to start, you're going to see an implosion in auto debt and credit card debt, and it'll spill over into mortgage debt. I mean, you've had, in the first 2 months of this year, almost 25% of the mortgage issuance went to people who were taking out mortgages with a debt-to-income ratio of between 45 and 50%. All right. So what's going to happen is the price of gas keeps going higher. They're going to get squeezed. So they're going to have to decide if they're going to put gas in their car to drive to work, or if they're going to make their car lease or car loan payment, their credit card payment, or their mortgage payment. At some point, they're not going to be able to make all three.
Right. As John Williams said, you got to make a decision. Either you're going to eat steak or you're going to have some chicken.
Right. I think he even makes more stark contrasting statements than that.
Yeah, he actually that following the mortgage crisis back in 2007, I thought the auto crisis was going to be right on the heels of it, but somehow it stretched out.
Well, we're seeing it now because right now auto loan delinquency rates are higher than they were in 2008, 2009.
Last question, current events. We've seen Trump pull out of the Iran deal, and we've seen Europe coming in and saying they're going to buy Iran's oil in euros. What's your opinion on that?
It's just just a continuation of the movement. The world wants out of the dollar as the
Right.
reserve currency, and China and Russia are actively working on that. And the European statement about settling trades in euros instead of dollars, I think, was in response to the Trump-Iran situation, pulling out of the Iran deal. So I don't know if that's just a threat or if we'll really see it. I think eventually we will really see it because I think at some point Russia and China are going to start saying, look, we're not settling trades anymore in dollars. We're not there yet. We're not at that point yet where we're going to see that. But certainly Russia and China, they trade with each other in their respective currencies.
Right.
And I know a lot of the Middle Eastern countries are now selling oil to China and settling the trades in wons. And that's what the won-based oil contract that was rolled out a couple months ago in Shanghai, that's what that was all about. And so, the writing's on the wall that the end is near for the dollar as the reserve currency, and that's going to cause a lot of problems in this country.
Right. So I guess as the world tries to figure out what they're going to do with fiat currencies, it might be a good idea to store your wealth in gold and silver.
It's never not a good idea.
I hear you. Hey, Dave, before we wrap up, could you tell us more about the fund that you manage?
It's a small. We've had it since about 2008. It's a small physical bullion and mining stock fund, and the base case model is half physical bullion and half mining stocks, and it's structured like a hedge fund, and you have to be an accredited investor minimally to invest in it. And we have it set up so that when you cash out, you can opt to take part of your cash out in the delivery of actual physical gold and silver that we keep in a Delaware depository.
Okay, so this is something for accredited investors to participate in.
Yes, and we way outperform the market in up markets. We've well, when I say the market, I mean our benchmark index. And then in down markets, we probably underperform it a little bit, or we do underperform it a little bit, just because we're overweighted in junior mining stocks. So if we get another big takeoff in the sector, which I think we will at some point here, this fund's going to do really well.
Right, I hope it does. And if you don't mind, could you also tell us a little bit about the journals that you publish at Investment Research Dynamics?
Sure. I write and publish the Mining Stock Journal, which is twice a month, every other Thursday evening, although I released it early last night because I had some really interesting information in there for my subscribers about a couple stocks, and I wanted them to have a couple days to digest it this week to make a decision if they wanted to buy them or not. And I essentially, each issue, I provide a little bit of my own market commentary and views on what's happening, and then I update the stocks that I call it my portfolio of stocks that I've recommended, and I'm constantly searching for new ideas to recommend. And I've had at least 3 or 4 stocks since I introduced the Mining Stock Journal that have gone up 500, 600%.
Wow.
There's been one that completely bombed out, and that's because there was fraud involved, and there's a huge lawsuit going on with that right now. And I had prefaced it when I presented it that it was an extremely risky situation.
Mm-hmm.
So in general, I'd say that my picks have outperformed. They've definitely outperformed the ETFs, the GDX and GDXJ, and they've probably outperformed most small, I recommend concentrated positions and not being too diversified. So I would say that my picks in general, since I debuted the journal, have outperformed the sector by quite a bit. And then I have the Short Sellers Journal, which is a weekly. And again, I provide my market commentary, what's going on. I try to pull back the propaganda smoke that surrounds the economic data and demonstrate with actual data what's really going on. And then I try to present a couple short ideas. Some have worked out and some have been disasters, quite frankly. But that's the way this market's been. Currently, I've been focused primarily on home builder stocks in the housing market, and there's been a quiet bear market going on in home builder stocks, and so my subscribers and myself, because I document all my trades in my journals, my subscribers who have been following up on my home builder short ideas have been doing really well for the last, call it 6 months. And I also, I recommend shorting stocks outright as your first, that you're giving you the best chance of success over longer periods of time. But I also present put trade ideas, and that's mostly what I trade.
Okay, and so all this information, our listeners, they can find it at investmentresearchdynamics.com.
Yes.
Okay, well, I'll be sure to get the word out, and hopefully we can get some people to visit you and see what you're all about. Dave, you're one. I appreciate that, Patrick. Yeah, no, thank you. I appreciate your time. You're one interesting guy, and I will have to be on the lookout for dogs vomiting as I walk about the town.
Just come walk throughout the suburbs in the United States, and you'll see plenty of dog vomit all over the place.
Okay. But Dave, again, we thank you for your time and thank you for coming on the show. It absolutely was a pleasure to have you on the show and share your views with us.
Oh, the pleasure was all on this side of the internet, Patrick. Thanks for having me.
Thanks again, Dave. Thanks for being here.
Yeah, the next time we do this, I'll get ready for video because, as you can see, I'm handsome. So
yeah.
Just kidding.
That was Dave Kranzler from investmentresearchdynamics.com with his views on gold, the stock, and housing markets. To find out more about Dave's work, please visit his website, investmentresearchdynamics.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on our new content.